Good afternoon. I'm calling this meeting of the Tax Committee to order for March 12th, 2024. First item on the agenda is approving the minutes from March 7th. Do we have a motion? Vice Chair Norris.
Chair Gomez, I move adoption of the minutes from the March 7th meeting.
Vice Chair Norris has moved that we adopt the minutes from March 7th. Is there any discussion on the motion? Not seeing any. All those in favor, please signify by saying aye. Aye. Any opposed, please say no. Motion carries. The minutes for March 7th, 2024 are adopted. So we're switching up our agenda a little bit here. One of our testifiers has to get to the lesser body. So first up is Representative Norris with House File 3327, and then we'll switch over to the Tax Incidence Study, which I know y'all. Oh, sorry. Oh, wait, right, it's Norris Day. Wrong one, 3667 first. Thank you. Welcome to your committee, Vice Chair Norris. Representative Norris is going to move that House File 3667 be laid over for possible inclusion in the 2024 tax bill. Vice Chair Norris, to your bill.
Thank you, Chair Gomez, and thank you for your indulgence on the quick change in the order for today. House File 3667 has to do with the tax implications of coerced debt. So economic and financial abuse of survivors of domestic violence is all too prevalent. It occurs in nearly all instances of domestic violence. Last year, I was proud to carry the Coerced Debt Bill, a bipartisan piece of legislation that provides survivors of domestic violence a path to get out from under debt that was forced upon them by their abusers. Under the bill, a survivor who can show a debt was coerced and involuntarily incurred can ask a court for a declaratory judgment that the debt should be extinguished. Minnesota is now one of only 4 states that offer this critical protection. But after the bill became law, it occurred to us that such a canceled debt might carry with it tax consequences if the creditor issued a 1099-C. That would be an unfortunate and unintended consequence of this landmark legislation. The law just went into effect in January, so it's too early to tell whether such an unwanted consequence of this good law will occur, but we wanted to close the state barn door before the House gets out, which is why we are here before you today.
Thank you so much, Vice Chair Norris. Testifiers, welcome to the committee. Mr. Elwood.
Thank you, Madam Chair, members. Ron Elwood, Legal Aid. Thank you for your indulgence. I really appreciate it. And I'm happy to stand for questions. Pretty straightforward bill, but I just want to just profoundly thank the Department of Revenue. When we came to them with this issue, they really were just so responsive and helpful in helping us craft this bill, the language, to make sure that, as Representative Norris said, an unfortunate and sadly ironic, unintended consequence we can avoid. So thanks again very much.
Thank you. Is there anybody else in the audience who wishes to testify on this bill? Not seeing any. Are there any questions from the committee before we let Mr. Elwood take off? All right, not seeing any. Your work here is done. Mr. Elwood, thank you for being with us. Any questions for the author or on the bill, the underlying bill? No? Well, they just want to razz you about not bringing donuts, I think, so we're not going to get into that. Not recognizing anybody who wants to talk donuts, but if you want to talk, taxes, we can do that. All right. Other pastries, we'll see. Maybe we'll allow it. Representative Norris, did you want to say anything else about your bill before we lay it over?
Chair Gomez, I'll just add that while we're addressing this at the state level, it's my understanding that Senator Tina Smith and Senator John Cornyn of Texas have teamed up to work on this at the federal level as well. I also understand that Texas is another state that has done this. I hope that doesn't cause you to look less favorably upon this bill, Chair Gomez, but would ask for your support and the support of the committee.
All right. Thank you so much, Representative Norris. And with that, House File 3667 is laid over for possible inclusion in the 2024 tax bill. Okay, excuse me. I hopefully we did that right. Right. I forgot. Representative Davids didn't remind me today. Welcome, Mr. Willett. So we're going to go back to our regularly scheduled events here, and we're going to get into the tax incidence study, which you all have a copy of in your packet, printed out. Thank you, Ms. Savis. And I'll turn it over to you, Mr. Willett. Thanks for being here.
Madam Chair, members of the committee, thank you very much. My name is Eric Willett. I'm the Director of Tax Research at the Minnesota Department of Revenue. I work with my team to prepare this study every 2 years. The tax incidence study attempts to answer the question, who ultimately bears the burden of the taxes imposed by Minnesota state and local governments? It is our biggest project that we do. It's a large undertaking that takes most of my staff's involvement in various parts of it. Yeah, so I'm honored to present it to you today. What I'd like to do is give a very brief overview of how we do the study for just a few minutes, and then we'll get into the results. So the tax incidence study was a pioneer when we first did it in the early 90s. We were the first state to do a comprehensive tax incidence study, and we've been tweaking and enhancing it ever since. This is, I think, maybe the 18th. I don't remember off the top of my head, but we've been doing it for quite a long time. And it's still the most comprehensive, regularly produced tax incidence study by any state. So what makes it more comprehensive than other tax incidence studies? We don't just look at state taxes or just the income tax or just general fund taxes. We do the entire portfolio of state and local taxes. We focus on the distribution of all the state and local taxes and who ultimately bears the burden by income and some other demographic characteristics. But this doesn't mean that we include all taxes that Minnesotans pay. Taxes you pay when you're traveling to another state, or if you have work in another state, and your federal taxes are not part of this analysis. This is Minnesota's state and local taxes, the share of them that fall on Minnesota residents. So I won't dwell on this. There's a table on page 22 of the report that shows all the taxes and the 2021 dollar amounts. First, the business taxes. The largest ones by dollar amount are the property taxes that businesses pay, and the state sales tax and motor vehicle taxes that businesses pay, and third is the corporate franchise tax, and combined those are over 90% of the taxes that are initially paid by business. On the individual side, the individual income tax is by far and away the largest tax. Homeowner and cabin property taxes are $5 billion. The sales tax that is borne by consumers, not businesses, is about $4.5 billion in 2021, and on down the list.
We talked about this. I think Mr. Willett's cool if people chime in, so yeah, please get on the list. Did you have a question, Representative Lee?
Yeah, Madam Chair, I had a question about business taxes. So I don't know if it's more appropriate to wait until later after the presentation or to ask now.
Probably we'll wait kind of until he gets into that section, but we'll get you on the list for a business tax question. Mr. Willett?
Business tax incidence, it's not obvious how to measure the ultimate incidence of business taxes. So we use economic theory and the comparison of tax burdens on capital in Minnesota versus nationally to estimate what share of the tax that is initially paid by businesses is shifted to the business owners in terms of a reduced rate on capital versus labor in terms of the reduced pay for work, or consumers in terms of higher prices. This is the long-run effect of taxes on businesses. Initially paid by business, it sometimes takes markets a while to adjust to cost changes, but over the long run, we assume that ultimately either the owner of the business, the customer of the business, or the worker of the business is going to pay the burden of taxes that are initially paid by businesses.
Great. Mr. Willett, I know that Representative Elkins had a question.
Yeah, just to the slide.
Yeah.
So where do the assumptions go about the distribution of the business tax between the business and consumers, for example?
Mr.
Yep.
Willett?
Madam Chair, members, there is a section in the report in Appendix B that discusses how we do the modeling of business taxation. and it's a little more complicated than I can probably describe verbally, but I can say generally in sort of broad themes how it works. So we assume that capital will, over the long run, flow to where it can earn the highest rate of return. That's not necessarily where the taxes are lowest, but it's where that business can earn, that type of capital can earn the highest rate of return. So over the long run, if Minnesota's extra cost on capital from taxes is higher than the national average, then that is going to be borne more heavily by Minnesotans because the businesses, it's unlikely business will completely shift its prices for a cost. If it's a multi-state business, it's unlikely the entire cost of that tax that's only borne on a portion of their market will be shared, that they can increase their prices if they're in a national market for the entire share of that tax. So the tax if the tax is the average tax of capital anywhere, it's hard for owners to escape that because that's just the cost of capital anywhere. So inasmuch as Minnesota's taxes are equal to or less than the average cost of capital, that's going to be borne by capital owners. It's like a national corporate tax at that point, where it's just the cost of doing business in the country. Whereas if the taxes for a particular business sector are higher in Minnesota, that differential above the national average is going to be borne more heavily by Minnesota consumers, workers, and land owned by businesses in Minnesota because land is immobile and that capital can't move.
Great. Representative Elkins.
Yeah, thank you, Manager. I will take some of my deeper questions offline with Mr. Willett, but I have just one example I'd like to just, so Wisconsin's gas taxes have always been higher than Minnesota's gas taxes. But if you look over time at the difference in gasoline prices between Minnesota and Wisconsin, as an example, the difference in the prices has never fully reflected the difference in the taxes. And, gasoline is by and large coming out of the same refineries. And, my theory is that basically it's a commodity in this case, that the price is being set in the market, and the market clearing price really isn't affected very much by taxes. And I think there are probably examples of that at the other extreme as well, things that aren't, or like drug prices that are, very high. The manufacturer is extracting the most they can, and the exaction of a tax probably isn't going to affect their assessment of what's the maximum that the market will bear. But I can take that up with you offline.
Madam Chair, to that point, that's an excellent point, and we do treat the taxes on business short-term business inputs differently and differently than the price of the cost of a capital investment, for example. So we do break the businesses into different sectors, different types of activity, and if there's a sector differential, like an entire industry is taxed at a different rate nationally, like petroleum, then it's less likely that Minnesota has a high Minnesota differential. So that would mean more borne by the capital rather than the customers.
Great.
All right,
Thank you. All right.
So important in this analysis is that a portion of the taxes levied by the state and local governments are exported, either because they're ultimately paid by visitors to Minnesota who are making purchases, or to people who are making remote sales from Minnesota businesses, or because capital owners who live in other states are bearing a share of the cost. So for each of our taxes in the tables, you'll see an export share. For the corporate tax, for example, in this report for 2021, we estimate that fully 1/3 of the dollars are paid by non-Minnesotans. That's a higher export share than some other taxes, like sales taxes are borne more by local consumers. And obviously individual income taxes are mostly borne by Minnesota residents. But on average, about 15% of state and local taxes are exported. Now, there is a corresponding amount of taxes that we're all paying to other states, so that doesn't mean Minnesota is getting a general discount on taxes, but it does mean that the taxes we levy are not all paid by Minnesotans. Another thing that differentiates our study from some is that we don't limit our study to income tax filers. The income tax filers are the easiest group to analyze because we have really good information about their income and where they live and that sort of thing. But almost 13% of Minnesota households don't file income tax returns, and over 10% file neither a PTR or an income tax return. A lot of these are seniors who do not have a filing obligation because their income is taxable income is below the filing requirement threshold. But we do try to, we bring them into the study. So we build a incidence database that includes non-filers based on other sources of information about income besides just income tax. So that's a big part of the lift for creating this study, is building the database that allows us to include the impact on non-filers.
Mr. Willett, we just had a question from Representative Joy.
Thank you, Madam Chair. Question for you. You say 13% of household income tax do not file a return, right?
13% of households do not file an income tax return, the way we define households, and I'll talk about that in a minute, but yeah.
I was going to ask you to define that, but
Yeah, well, I can do that now, and then I can skip the slide. So most people, when they think of household, they think of the census definition of household. The census is interested in place. How many people live in this dwelling unit? But we're analyzing tax burden, so we're looking at households. We informally call them tax holds, and it's basically the people who are all related to an individual income tax unit. So a married couple and any dependents that are claimed are one household for the purposes of this study. 3 college students who all live together in the same unit but all file separate taxes are 3 tax holds for the purposes of this unit, for the purposes of this study. So compared to the census, we have more households with smaller household size on average, but we're including the same population as the census.
Thank you.
no, it's great numbers just to have that, Madam Chair, just because when we were talking about the renter's credit having to file to do this, I wonder if we'll put these people back into having to file to get that renter's credit. Just kind of good information. Thank you.
Yeah, I think that's a really good point, and we're sort of encountering, we have a lot of folks that we know would qualify for the child tax credit, but because they don't have liability, they don't file. So that's something that we are like needing to just be thoughtful about and put resources into to just like make sure that people know that they have to file. So thanks for that question, Mr. Willett.
So the way a lot of the information in the report is shown is that we divide the population into 10 equally sized groups of households called deciles. So, basically we line up the population by lowest income to highest income. The first 10% with the lowest incomes in 2021 are the first decile. The last 10% with the highest incomes are the 10th decile, and then each in between. So 10 equal groups, equal number of households with very different amounts of tax in them. If you look at table 2.2 in the report, you can see how much income, even though there's the same number of households in each of the deciles, how much more income there is in the upper deciles than in the lower deciles. The lowest decile, the first 294,000 households have income less than $15,500 in 2021. The highest income, same amount of households, has incomes over $184,400. So a big difference in the average income within each of the deciles. We use the broadest measure of cash income that we can find. So we're trying to capture as best as we can what total cash resources does a household have to pay its tax liabilities, so that we can come up with the most uniform measure of how burdensome the taxes are. So it's not just federal gross income, but it's also non-taxable income that is income they have available, like non-taxable Social Security or pension incomes. Also transfer payments that are cash transfer payments for any programs that a household might participate in. And any voluntary contributions they're making to retirement that they could keep for cash needs. Unique to 2021, unique to this study, was also the federal stimulus payments that were received in 2021, the economic impact statements, impact payments, and I'll talk more about that when I talk about the income distributions. However, we don't include all income, and this is important when we talk about the first decile. We don't include in-kind assistance like food stamps and housing assistance and medical assistance. It's hard to put a dollar value on that, and that is not not something that can be turned into cash to pay your tax liability easily. And other sorts of fringe benefits and pre-tax contributions to programs are not included in the definition of income. But still, it's about as broad of a measure of income as we can come up with. So I'd like to talk about the results for 2021. 2021 was a very unique year, and I'll get to that after I talk about the results, what made it such an interesting year and caused us to make some choices about how we presented the information in the report. So this chart, which is on page 26, shows the effective tax rate by decile of state taxes and local taxes. And let me explain what you're seeing here. This is all the taxes paid by the 294,000 households in each decile divided by all the income of the people in that decile. So what is the average tax as a percent of income in each of the 10 deciles? And the pattern that you see is a pattern that you see if you look back in the old reports as well. A much higher percentage in the first decile, starts to go down, then flattens out, but still gets a little bit lower at the top end. And then we zoom in on the top 5 and 1% on the right-hand side, so you can see a little bit more detail on the top end. What this means is if a chart like this gets lower from left to right, the tax is generally regressive. The distribution is regressive, and I'll talk about what that means in a bit. If it gets higher from left to right, then it's progressive. If you look just at the dark blue, which is the state taxes in isolation, that's actually, other than the first decile, it's kind of progressive because it gets bigger. The people in the upper deciles are paying a higher percent of their income in state taxes than the people at the lower deciles, other than the first decile. The local taxes, which primarily property taxes, but also a growing share of that is local sales taxes, get smaller the further to the right you get. So people in the upper deciles are paying a smaller share of their income in local taxes than people at the lower end of the income level. So the local taxes are regressive on the whole. The state taxes, primarily due to the income tax, are progressive on the whole. What you'll see in the legend box at the very right-hand side is something called the Suits Index, which is a general measure of the overall regressive or progressiveness of the entire tax. And I'll talk about what this means in a few minutes. So just remember that the local taxes have a negative or regressive Suits Index. The state taxes have a progressive or positive Suits Index, the plus 0.55. Before I get into that, though, I always have to give out a caution about the first decile. The first decile is unique for a lot of reasons, so the higher number should be taken with a grain of salt. There are some households in the first decile who are temporarily income poor, but don't necessarily have a long-term trouble with ability to pay. Think of people with business losses in one year that may have successful businesses they own in other years. We see a lot of people like that dropping in and out of the first decile from one study to the next. In this study, there were 7,000 households with negative incomes, which is primarily from business losses, averaging $150,000 of business losses on average for those 7,000. If you remove them from the first decile, then the effective tax rate would drop to 20% instead of 24%. So they do affect the height of that first decile quite a bit. There's also, as you may remember, I said non-cash transfer, non-cash benefits like food stamps and housing assistance are not reflected in here. And clearly people who are getting those and also have a small income don't have to put that low income to as much to housing and to food. So this kind of overstates the burden of that tax burden on them in as much as we're not capturing that relief from those paying for those necessities.
Great. I think Representative Lee had a question.
Yeah, different question, but I guess about this slide. Wanted to just to better understand. So you mentioned that's the households with like negative 150K a year. So wondering if you can tell us like what that actually looks like in practice, because I mean, does that mean people are like eating thin air, or like, you know, what does that actually mean in practice?
Yeah, Mr. Willett.
Madam Chair and Representative, with a lot of businesses, business income is volatile. Some businesses have a string of years where they're losing money, and that might mean that the owners of the business are in severe financial trouble. So that, I mean, that there are economic, but there are also people for whom the businesses have up years and down years, so they may have savings and other things they can draw on for personal expenses during a year when their business is not doing well. So it doesn't mean that those 7,000 households have no problem with ability to pay. It means that a portion of them likely are temporarily having negative income, but not necessarily having a short-term problem with paying their expenses for that year.
Okay, great. And of course, that's, you know, the majority of businesses in Minnesota are organized as pass-through entities, which means that that goes on to their just regular income tax. And so that's why all the part of why so many caveats about that lower decile, but good question.
Yep, thank you, Madam Chair. I should have clarified
Yeah.
that this is the impact of pass-through entities and the owner's tax returns for pass-through entities.
Great. Mr. Willett, thank you.
Okay, so I'm going to talk a little bit about suits index. So the effective tax rate bars is a really good way to sort of visually see whether a distribution is relatively progressive, getting higher percentages as you go up the income, or regressive, going in the other direction. But for a single number that kind of sums up the entirety of whether a system is on net, progressive, or regressive, we use a measure called the suits index. The suits index is a measure that goes from -1 to +1. You'll rarely see a suits index number near those. But imagine if, you know, we did that lineup of all the households from the lowest income to the highest income. If every dollar of tax was paid by the poorest income, you would have a -1 suits index. So the entire burden is falling on the poorest one household in the state. At the other extreme, if the entire tax burden was paid by the one highest income household, you would have a +1 suits index. All of the taxes borne by the one with the highest ability to pay. Clearly, neither of those is a realistic outcome. But as a visual, so if the other alternative would be a perfectly proportional tax system where everybody pays exactly the same percent of income in tax. And if you plotted that out, it would be a 45-degree line with the percent of tax, the cumulative percent of tax paid up the top, the cumulative income across the bottom. So 50% of the people who have 50% of the income would pay 50% of the tax. People who have 90% of the income would pay collectively 90% of the tax. That would be a zero suits index and a perfectly diagonal line, which also does not exist in the real world. So what the suits index does is it plots the population, and where the dots are going to be above and below this. Some people are going to be above that average effective tax rate. Some people are going to be below. But if you sum up if you draw the line and you sum up the area, the distance between the ideal 45-degree line and where the line actually is, that's how you calculate a suits index. So a bigger negative number means more of the tax is borne towards the beginning end, so the line goes above the 45-degree line right away and gradually goes to the 100 at the top. A progressive tax would have less of the share of the tax paid right away and then more of it paid at the very end, so it would scoot up to the 100% at the very end. So if the area is below the 45-degree, it's a progressive tax. If it's above, it's a regressive tax. That's mechanically how the suits index works, but it's mathematically a tidy way to sum up all these individual points into a single number. It doesn't mean, and there's no right suits index, there's no correct answer, but it's a mathematical way to compare one system to another. So Minnesota's system has a lot of different taxes that have very different suits indexes. So this chart, which is on page 35, if you want to zoom in on it, shows the different taxes. The size shows how many dollars they raised in 2021. The bigger the circle, the more dollars they are for state and local governments. The further to the right they are, the more progressive their distribution is by suits index. The further to the left, the more regressive. And what you'll see is there aren't a lot of dots to the right. We don't have many progressive taxes. Most taxes are regressive. The income tax is by far and away the largest tax. It's also progressive. And there is a page at the back of the report for each of these taxes individually where you can see the distribution by deciles and some other information, what share of it is exported, for example. So you can get more information about each individual tax. Most of the taxes are regressive. They're to the left of the zero line for the suits index. The exceptions are the income tax, the estate tax, and property tax refunds, which are actually just sort of part of the property tax system, but because they're so progressive, we show them as a separate. And the dot did not show up on the screen, but it is in the report. It's right under the property tax refund label in the upper right on the screen. I'm not sure what happened with my slide. So this shows that same decile. The total percentages are the same, but rather than divvying it up state and local, we're divvying it up by tax type. And the dark blue at the bottom, I understand you have black and white in the printed copies, but the first row of colors in the report gets much higher to the right than to the left. That's our personal income tax. That is the progressive tax. The numbers are very low and actually negative in the lowest deciles because of refundable credits. On net, the households in the lowest 2 deciles are getting more money out of the income tax system than they're paying in. Whereas on the very far right-hand side, the top deciles and the top 5 and 1%, the bulk of the taxes they're paying is the personal income tax. All the other taxes you see get smaller as you go from left to right. They're all regressive taxes. So a bigger percent of income being paid in these taxes on the left side rather than the right side. Importantly, the dollar amounts are still bigger on the right. So if you look at the dollar amounts on table 2.2 rather than the percentages, you know, a big share of the dollars are being paid even in these regressive taxes by the upper incomes, but it's a smaller share of their income, even though it's bigger dollar amounts than the lower incomes. So deemed to be, by the measure of effective tax rates, less of a burden because it's less of a share of their total income. This shows the history of the overall effective tax rate since we've been doing the study. So the first one was 1990. And it has undergone some changes, but you'll see you know, it's kind of within a range of 11 to 13% over the last 30 years now. So there is some variation. This has something to do with tax policy, but it has a whole lot to do with economic trends as well in terms of whether personal income is growing faster or slower than tax receipts. And that can be irrespective of any decisions you all make or local government officials make. Is one of the key findings of this report is that sometimes economic trends swamp tax policy. So you work really hard to get an outcome, but then the trends in the economy give you a very different result than what you expected. And we see some of that in 2021.
Great, we have a couple questions. First, Representative Davids.
Thank you, Madam Chair and Mr. Willett. I do find it interesting, the effective tax rates, how pretty much steady they've been since 1990. It just hasn't changed a whole lot. But, and maybe we could talk afterwards. I don't know if you have the answer to this question, but how does Minnesota compare? How would they compare on a page 18 here, like with surrounding states?
Mm-hmm.
Mr. Willett?
Madam Chair, Representative Davids, that's an excellent question. We do compare ourselves to other states on the suits index measure, regressivity, progressivity. We have not collected the effective tax rate information. I think there are reports that do that I can try and find. I mean, I think if you look at real aggregate at state and local taxes as a percent of personal income, with census data, I think we rank a little bit above the middle overall and really high on some taxes and less high on some other taxes. But I don't want to misspeak off the top of my head, but I can get some information for you on that.
Thank you, Madam Chair.
Yes. Representative Lee.
Thank you, Madam Chair. Mr. Willett, I just am wondering if you can explain to the committee what the graph is adjusting for in certain years and why those years and not others.
Mr. Willett.
Oh, shoot. I'm pretty prepared, but I'm not prepared for every question. There is some conversation that perhaps on page 17 where the figure is, I think there might be a footnote that explains that, but I don't remember off the top of my head. I think some of it has to do with some methodology changes that were done because of enhanced data. We used more crude measures early in the study, and I think we did some retroactive changes to try and make the numbers comparable. But beyond that detail, I'd be speculating.
Thank you. Great. We'll get that info later. And I'm appreciative that Representative Davids asked a question about effective tax rates in relative to other states, because I think this is something that we dig into in our committee is our on some of our, kind of like some taxes, you can say, oh, we have the highest X rate, or we're in the top. We have relatively high income taxes compared to some other states. However, my brother lives in Texas. I mean, you should see his property tax bills. And so, these are all trade-offs, because as we talk about, right, like government has to be funded, local government in particular has to be funded. And so if we don't have, progressive tax tools that we are utilizing at the state level, and we just get to put those decisions off onto our local partners, a lot of times they have to resort to more regressive kind of tax tools. And so, I think if we're going to really be comparing ourselves to other states, we do want to look more at this effective tax rate rather than maybe isolating a single tax type and saying, oh, that rate is higher than another state, because it's not really the entire picture, which is sort of the beauty of this study. So, Mr. Willett.
Madam Chair, one more thought to that point. This is just taxes. It doesn't include government fees and charges. And I don't know if it's still true, but back when in a previous position, when I tracked it closely, Minnesota generally relied less than the average state on non-tax resources and more on tax resources. So the more comprehensive of a revenue basket you can get for your comparison, you'll see a different result than if you look just at taxes.
Yeah, very good point. Great, thank you.
I wanted to talk about a couple of narrow findings in the report. Looking at specific features of the tax system and what they do to the progressivity or regressivity of the system. We could do analyses of a lot of different features, but we zoomed in on a couple just to give you a sense of the power of them. Refundable income tax credits, which would be the working family credit, dependent care credit, and K-12 credit. This is 2021, so this does not yet include the impacts of last year's changes, which would add the new child tax credit. What I'm going to say probably will be accentuated even more in future studies. But if you look at the bottom line, the overall total, the overall income tax for all taxpayers is about 4.9% without the credits, 4.8% with the credits. So really, in an aggregate, doesn't have that big of an impact on effective tax rates. But if you look at the lower deciles at the top of the chart, those refundable credits really have a large impact on what the ultimate burden of the income tax is. Instead of having a positive 4% in the first decile, you have a negative 4%. So that's the power of the impact of those refundable credits. Similarly, the property tax refund, which is income tested but not quite to the level that the refundable income tax credits are, same sort of thing, except I'm showing it in line form. Without the PTR, the homeowner property tax would be the blue bar up above, which is much more steeply regressive. Once you layer on the property tax refund, it lowers down to where the red bar is. Much bigger impact on the lower deciles than in the upper deciles, where you're reducing the effective tax rate of the homestead property tax through the property tax refund program. It has very little impact at the upper deciles, where households don't qualify for the regular PTR, only the targeting PTR, but has a much bigger impact on the lower deciles where they're income qualified for property tax refunds. Okay.
Great.
There's an alternative look at the data on pages 45 to 58 or 48. So instead of dividing up the population into the lowest 10% of households and the upper 10% of households, we look at the lowest 10%, the 10% of income. So the lowest income households until we have 10% of the income, and then the next 10% of income, then the next 10% of income. Those are called income deciles rather than population deciles. So with the population deciles, I said same number of households, way different amount of income. With the income deciles, you have the same amount of income, but a way different number of households in each of the deciles. And I compare the two in this chart, where you see the first four population deciles, which is about 1 point something million households, are all squished into the first income decile because collectively they have 42% of the income. They're more than 40% of the households, but only 10% of the income. And the opposite is true at the other end of the chart in the blue, where the 10% in the population deciles, the 10% highest income households cover 4.5 of the highest deciles of income because they have 45% of the income in the top 10% of households. The reason we do this is because some people want to drill down more deeply into the upper income groupings. So these tables on pages 45 to 48 allow you to see more nuanced detail at the upper end. If you're more interested in zooming in at the lower income deciles, you want to use the population deciles that are shown before that in the report. Same data, just a different way to group the results. And you get different results because there's so many. The first 4 deciles of population deciles are in the first income decile. The effective tax rate is much lower in that first income decile, has a lot more households in it, and it's roughly an average of the effective tax rates of the first 4 population deciles. And then the opposite is true on the top end. The 10th decile of population gets split into 4.5 deciles of income, where you get a lot more detail. And that top 10th decile of population of income has an effective tax rate of 11.1%. Also in the report, a little bit after that, pages 63 to 75, we divide the population into different types of households to give you a bit of a demographic variation on the results. So we divide the population into 6 household types: married with children, married couples without children, married seniors, single parents, single non-seniors, and single seniors. So those are the 6 household types, and there's a table for each of them in that section of the report, and you can see the results by decile for each of those subgroupings. One of the things that I'll point out, which is on the slide, is how different the median income is for these different populations. All married with children households in the state have an average median income in 2021, a median income in 2021 of $140,000. Senior single households have a median income of just $36,500. And that's the median, so that's half are above, half are below. So this is not an atypical result. The numbers might be a little further apart than we've seen in last reports, but this is generally typical of the different household types.
Yeah, well, I heard everybody whispering, so there's got to be questions on this one. Representative Brand.
Thank you, Chair Gomez. The question, I guess, is I know what my district is, and it seems high. Is this just because we're looking at folks in the metro along with folks outside of the metro, and that's why it looks higher to me?
Mr. Willett.
Madam Chair and members, yeah, we make no geographic distinctions in this report. When you create a large sample that's intended to represent an entire population, the more different ways you want to drill down, the bigger your sample has to get reliable results, and we've never stratified for geography. But yes, if we were to do this study at a micro level in different parts of the state, you would see vastly different numbers. And you can see the overall median income in the demographer's office data, and you can see regional differences there. And I would guess that these sorts of numbers would hover around that different median from place to place. You'd still have the higher and lower from that point with these different categories to some degree, but there's going to be variation.
Great question. You good? All right, back to you, Mr. Willett.
Okay, I want to do a little bit of comparison from the last study to let you know how things changed between when we did this study with 2018 data and 2021 data, and then I'll talk a little bit about the future after that. In the 3-year period between 2018 and 2021, there was pretty healthy income growth overall, and I'll show a chart in a few pages, but it was not uniformly distributed. Wage, business, and investment income heavily weighted towards the upper deciles, the growth from 2018 to 2021. Those economic impact payments that were temporary in 2021 and the increased unemployment payments that were made in 2020 and 2021 were very significant at the lower income deciles. So those partly but didn't completely counteract the wage and business income growth differential at the upper incomes. And I'll show the distribution in a couple minutes. There were other impacts of the economy in 2021 that we had to think about when we were looking at the results of this report. Part of what we do for distributing consumption taxes, cigarette, alcohol, tobacco sales taxes, is we look at a consumption tax model, which is based on national survey data of household expenditures and business expenditures and how those vary by household type. And because of the pandemic, 2021 consumption patterns were very different than we'd seen in past reports. So that trickles through to some of our findings for the regressivity and how much of these excise taxes are exported. You might remember there was a lot less travel in 2021. The hospitality industries generally were in rough shape. Retail overall was quite healthy, but which retail was doing well was very different than pre-pandemic. All those things, when you put them into the consumption tax model, give you a very different pattern of who was paying sales taxes in 21 compared to previous studies. And we assume, but don't yet know, that many of those effects are temporary, and with the next study, some of those things will revert to what we've traditionally seen with previous studies. Another really important thing that is not temporary, well, as of current law right now, is, you might remember when I was talking about business taxes, I talked about the difference between the average tax on businesses nationwide compared to the Minnesota taxes. So what is the average state and local taxes nationwide compared to Minnesota? For some of the business taxes, that gap grew between 2018 and 21. 16 of 44 states that levy something like a corporate income tax either reduced their rates or moved closer to single sales apportionment. Minnesota was a leader in single sales apportionment, one of the early adopter states, which gave us a competitive advantage that is being eroded as other states catch up and also implement single sales apportionment, which means that business headquarter location decision doesn't affect your corporate tax directly. Only where your sales occur affects how much of your income is apportioned to a state. So other states are reducing their corporate tax rates, some, or moving closer to single sales apportionment, which makes the Minnesota differential on corporations higher, which, after we do the analysis that I sort of overviewed but didn't describe in detail, results in a more regressive corporate tax with a little bit less exporting than what we've seen in the past. Another important finding of 2021 is I mentioned those income trends. This is, since we've been doing the study, what the distribution of the share of income is by population groupings. In 2021, we saw the most concentration of income at the upper deciles that we've seen since we've done the study. We don't do the study every year, so we can't say that it's the most extreme since 1990, but the way we measure it in the studies we do it, 2021 had a very extreme distribution of income. The top 1% was at 19.1% of income. The top 5% was 34% of income. So if you look across, those are lower down than in any of the previous studies. Let me jump ahead to where the growth was coming. So overall, between 2018 and 21, income grew by 23%. That's a really healthy, over 7% annualized growth rate, but was not uniform by type of income. Wages only grew by 12%, and that distribution was not uniform. It was actually, the growth was higher in upper decile wages than lower decile wages. Retirement income was virtually flat. Business income grew a little bit higher than the overall average, and that is generally more prevalent at the higher deciles than the lower deciles. Capital gains, the biggest year we've ever seen for capital gains. 2021 was a tremendous year for stock market performance. That income is also heavily weighted towards upper deciles, and those. But counteracting that a little bit was the large increase in unemployment. And then those one-time or temporary economic assistance impact payments that ended after 2021. What we know, we've got early preliminary sample of 2022. We know that investment in capital gains are returning back closer to that 2018 level in 2022. But the wage growth from 21 to 2022 is still higher in the upper deciles than in the lower deciles, so wages haven't gone back to pre-pandemic distribution. So that is still working its way through the system, or could potentially be a somewhat fixed feature of our near-term future.
Great. We just had a question or a comment. Representative Howard.
Thank you, Chair Gomez. Just a question. And this, excuse me, this slide kind of indicates, I think, what we've seen in our economy over many years, but accelerated during the pandemic, where we're seeing most of the concentration of economic gains at the very top, then at the middle and at the bottom. And I'm curious, long-term, if that market change affects how we look at progressivity or regressivity, in that, I guess, does everything start to look regressive, a little more aggressive when you have such concentration of wealth at the top? Does the percentage start to mean slightly different things as this wealth gap changes, I guess is the question.
Mr. Willett.
So, Madam Chair, there's a couple different ways to think about this. So inasmuch as we currently have a slightly regressive system, if there's more income at the upper levels that have a slightly lower effective tax rate, that is going to accentuate that regressivity to some degree, barring tax policy changes or shifting where the income's coming from and what the tax treatment of that income is. You can have some very high income households that don't pay much tax on it because it's mostly non-taxable income, tax exempt retirement income, for example. So it's not precisely, but that's generally what you would expect. If, on the other hand, if we have a progressive system, and we don't yet know the full results of the changes in last year's tax bill, which were very progressive in isolation, if the system were to tip to the progressive, then higher income growth at the higher income levels is going to bring in more tax revenue and accentuate that progressivity. So it just kind of depends on what the starting point is and if the income growth is in taxable income or non-taxable income.
Great, thank you. And Representative Anderson.
Thank you, Madam Chair. So I think I heard you say that the preliminary 2022 numbers actually go back to the 2018 numbers. Look like they are heading back to.
Madam Chair, some of them do. The business income and the capital gains and the unemployment all seem to be reverting to pre-pandemic, more typical levels. The wage growth being concentrated on the upper end is persistent in 2022, and the economic impact payments will go away. The retirement income starts growing again, I believe, in 2022.
Representative Anderson.
Thank you. So essentially, we had an anomaly, it sounds like, in 2021. Generally, capital gains and investments, for that to have gone up like that means people sold assets. So it was because of the sale of assets heavily in 2021, which is not, sounds like occurring in 2022, that this number is so high. Is that accurate?
Mr. Willett.
Madam Chair and members, yes, capital gains showing up on the tax forms means they're realized capital gains, so a sale has taken place, a taxable sale has taken place. So yes, that does mean that, and we think that part of the reason the retirement income slowed down was that for some people who were experiencing capital gains from sale of assets that weren't in their retirement income and had the choice about whether they're pulling retirement income out or not, did less of that in 2021 because of the availability of capital gains from other investments.
Thank you.
Great, thank you. All right, we're good on questions. Go back to the presentation.
Okay, how much time? This is a parallel slide just for the tax changes from income grew at 23% overall, total taxes grew at 20%, so slightly slower growth in taxes than in income, and that's why the overall effective tax rate from the 2018 study to the 21 study went down by just a small step. When taxes grow more slowly than income, your effective tax rates are going to go down. If taxes grow higher than income, then your effective tax rates are going to go up. Most notable here is, again, it might be an anomaly, is the 2021 corporate franchise tax. I think you had a presentation sometime the last couple of weeks where you saw how much the corporate tax receipts have grown the last few years. I, for one, am not going to predict how long that's going to be that way. Generally, the corporate tax follows the economic cycle, and we rely on the state forecast for what we think about what's going to happen to the corporate tax. But clearly, the tax changes were driven by the unprecedented growth in the corporate tax in those years. So this just compares the effective tax rate distribution from 2018 to 21. I mentioned that first decile is usually higher than it was in this report, and you'll see in 2018 it was actually almost 29%. Those economic impact payments and the increased unemployment insurance were one reason why that percentage in the lower deciles was in the lowest decile was moderated a bit in 2021. You'll also see that if you look across the whole population, the other next five lowest deciles all had an increase in effective tax rate, whereas the upper deciles had a decrease. So that indicates a slight increase in regressivity overall of the system between 2018 and 2021. Okay. The suits index, the overall measure was negative 0.13 in 2018. With the 2021 report, I mentioned that things got slightly more regressive, so we're measuring the overall system to be negative 0.024 in 2021, slightly more regressive than it was 3 years ago. Without the federal economic impact payments, the suits index would have been even more regressive, although without those payments, those lower income deciles wouldn't have been spending as much, so that's not exactly an apples to apples comparison. The income and consumption changes from the pandemic that I discussed, those trends had a bigger impact on the suits index than any state policy changes between 2018 and 2021. This is one of those times where economic changes that affected how people earn money and how they spend money had a bigger impact on our results than law changes between 2018 and 2021. And as I mentioned, the changes in other states' corporate tax rates and apportionment factors means that Minnesota's corporate tax got more regressive from negative 0.142 in 2018 to negative 0.175. Here's a history of the suits indexes since we've been doing the study. You'll see that in the early years, they bounced around, and we measured them as the most regressive in 2006. And since then, the system was getting generally more closer to proportional, less regressive, until this last study where we took a step back because of those income distribution and consumption changes and the other changes that I talked about. Still close to proportional compared to most state and local systems. And I'll turn to that in a couple of minutes. One of the biggest differences between this report and other reports we've done in the past, normally we will also do a projection year. So we will take our results from our base year and we will grow income and taxes and factor in tax changes so that we can give you an estimate of what the system will look like in a couple of years. As was mentioned, 2021 is a bit of an anomaly. We ran the numbers, we looked at them, we talked about them, we talked with some others about them, and we realized that 2021 is enough of an anomaly that it wouldn't be responsible to project those patterns forward and say anything meaningful about where we think we'll be in 2026. So we are not showing a projection year in this report. We fully plan to do that again if we're in a more stable economy with our base year with the next report in 2 years. In the absence of that, though, we didn't want to ignore the law changes. There were some significant tax changes in both the tax bill and other legislation last year that will have an impact on the next study. And we actually did an incremental incidence analysis of those bills last year that's available on our website. And I can point, I've got 1 or 2 copies here, and I can point people to it if they're interested. But from an incidence perspective, the biggest changes enacted last year were a very large child tax credit and changes to the working family credit with a very low income phase out. That's a very progressive suits index policy because you've got a lot of money, over $400 million, focused on the poorest households with children. On the other hand, on the other side, though, there was a tax increase of 1% on investment income over $1 million. That's going to be at the very far end, right-hand side of the top decile, because it's only people who have over $1 million of investment income in that year. And the faster income phase out of the standard and itemized deductions also mostly hits people in the upper deciles, and that's a tax increase. So what you've got in the tax bill in the income tax is tax increases at the top end, big tax decreases on the lower end, and that's going to have a very progressive impact by changing the distribution of the income tax. There were also regressive changes in both the tax bill and other bills. The corporate tax applied to certain international income. We don't really know whether the incidence of that particular type of corporate income is going to be as regressive as we measure the corporate tax writ large, but in the absence of any information or empirical evidence, we use the same assumptions as we use for the distribution of other corporate taxes. There were increases to future increases in indexing the gas tax, motor vehicle registration taxes, and sales taxes, all of which are regressive. Generally speaking, things that are at least partially necessities, people at the lower income deciles are going to pay a higher proportion of their income on those types of taxes than people at the upper end. So putting them all together, we measured that after exporting that the tax increases and decreases and all the legislation led to about a $426 million overall increase in the incidence of taxes, or about a 1.1% increase in terms of effective tax rate. Made the system more progressive overall, despite all the local sales taxes that are regressive and the consumption taxes. And as I mentioned, no projection year this year because 2021 was what we researchers call a goofy year. So we chose not to do that. So just one last visual. Oh, I guess I don't. So if you look at the analysis of the tax changes last year that we did, you'll see that on an effective tax rate basis, overall, they reduce the effective tax rate in lower deciles, increase the effective tax rate on upper deciles, and that's kind of by definition a very progressive change. You're doing that tilt lower on the left, higher on the right that we saw in those bar charts. The last thing I want to talk about is comparing ourselves to other states from a progressivity, regressivity. This doesn't answer Representative David's important question about overall levels, but in terms of given the overall average level, who's paying. As was mentioned and as has been found in past reports, Minnesota generally has one of the more progressive state and local systems. There are different ways to measure that progressivity. As I mentioned, we use the Suits Index. We don't have all the data for every state that we have for Minnesota, so we can't do as precise of a Suits Index measure for all states as we can do for Minnesota. But there is a comparative study by a group called ITEP that estimates effective tax rates for every state by 7 different income groupings. So they don't use that to calculate a Suits Index, but with the help of a consultant, we were able to take their raw data and do our own calculation of what Suits Index is for each of the 50 state systems plus Washington, D.C. It's a more limited data set. It doesn't include seniors and other non-filers, and it's only 7 points rather than the population points that we use over 100,000 points when we do the Minnesota Suits Index. But the overall results still give you an indication of, generally speaking, how progressive or regressive different state systems are. Using that Suits Index, we come in as the second most progressive state and local system after Vermont. The ITEP study itself uses a different measure that I forget what they're called, inequality index, I think they call it, which focuses much more on lower income population, the way their calculation works. And by their measure, Minnesota is second only to Washington, D.C. in its progressivity. But that's a different measure. The suits index that we've relied on for decades, Minnesota's number 2 after Vermont in terms of progressivity. Just to show the difference, this is comparing Minnesota to 3 of the most regressive states by this measure. Florida, Texas, and Washington, none of which have a general personal income tax. The personal income tax is the most powerful tool state and local governments have to put progressivity into the tax system. Minnesota is the dark line that's going generally up from left to right. These other states are generally going down quite significantly from left to right. So because they don't have an income tax where the tax grows as a percent of income as income goes up, they rely much more heavily on regressive taxes like sales taxes and property taxes. They have a much more steep left to right. And finally, comparing Minnesota to our neighboring states, the green is, the thicker green is Minnesota, the one that's going up from left to right. Our neighbors, Iowa, North Dakota, South Dakota, and Wisconsin, are generally going down from left to right to different levels of different degrees. And the numbers in the parentheses in the legend show the calculated suits index using this simplified 7-point suits index. So Minnesota is actually on the positive side using this cruder measure. We still have the whole system as negative with our more careful and detailed suits measure, but I think the comparisons between them, the relative comparisons of progressivity are generally reliable.
Wow, yeah, all right.
There's a lot.
We're gonna clap for that one, that was great.
I know my staff worked really hard on this, so I'm glad that you appreciate this work. I'm happy to take any more questions, either online or offline. Yeah, thank you for your time and attention.
Great, thank you so much. We're going to go to member questions first. I just have to say thank you so much for this, and to you and your staff. This document that we have, you guys, is just it's so valuable. I would particularly, we have a number of first-term members on the committee, and like dig into this. You will learn so very much. This information it's a lot of complex information, and it's put together in a pretty digestible way, and really, especially having this kind of shorthand, the suits index is really very handy as a way to quickly scan through the different taxes in our system and have some way to compare them. This is the first time that this has been issued during the time I've been chair, because we did a little switch because of the Tax Expenditure Review Commission. We kind of switch off between this and the tax expenditure budget every other year, and so I'm just realizing it's such a nerdy thing, but I'm like so excited that we have this, and we are like other states, because you kind of get to know other people, our peers in other states are all very like jealous that we have this big exhaustive document that really like is a way for us all to analyze our taxes. So cannot extend enough gratitude to you and your staff. Thank you so much. Representative Davids.
Well, thank you, Madam Chair, and I would like to thank you for taking the time in this committee to do this. This is something we've done over the years, and I think it's a very good thing. And I want to thank your staff for the documents they prepared for us. These I actually do keep, but somebody said I need to use an RQ code to do something or whatever, so I think I'm just going to stick with the paper.
Good call.
It's on the internet, so
Sounds
it's
like
got to
we
be
should,
true.
stick with the paper.
So thank you to your staff for this. I really appreciate that. This is something that I do pay attention to, and I think it's good advice that everyone on this committee pays attention to this. There's a lot of information here. I do have a question for the department. Do you support this study? No.
We might have to go to Ms. Bears for that. No.
Thank you, Madam Chair, and Mr. Willett, thank you. And to your staff.
Thank you. All right, anybody else? Okay, you've given us so much to think about. No more questions. Thank you so much again.
Members.
Appreciate it. All right, back to Norris Day. Norris and Mr. Willett Day. All right, we have Representative Norris with House File 3327. And Representative Norris is going to move that House File 3327 be laid over for possible inclusion in the 2024 tax bill. Welcome back. I see you have not managed to materialize any snacks for us in the last hour. Just going to express their disappointment on their behalf.
Dutifully listening to the presentation.
I understand that Representative Norris, you have an author's amendment.
I do, Chair Gomez.
Great.
I have the A1 amendment.
Would you like to move it?
I move the A1 amendment.
Great. Is there any discussion on the motion? Oh, it's a technical amendment?
Chair Gomez, this amendment, basically, this bill was introduced last year, and so since we're in a new year, it basically moves the effective date forward by 1 year.
Sounds fair. Any discussion on that? Not seeing any. All those in favor of the author's amendment, please say aye. Aye. All opposed, please say no. Motion carries. The bill is in the form you'd like it. To your bill.
Thank you, Chair Gomez. Under Minnesota law, military veterans are rightly eligible for a military pension subtraction on their military pension in honor of their service to our country. Similarly to the U.S. military, foreign service officers often serve in conflict zones or assignments where they and their families are at risk of personal harm. U.S. Foreign Service members are often assigned to dangerous and difficult overseas assignments in support of U.S. national security. And in fact, foreign service officers are sometimes stationed alongside our military members overseas. As a result, this bill would give foreign service worker pensions the same tax treatment as military pensions. This is a way for Minnesota to thank these officers for placing themselves in harm's way on behalf of our country, just as we do for our members of the military. And with that, Chair Gomez, I do have two testifiers who, true to form, have dutifully sat here through the entire tax incidence study, ready to present.
Excellent. Thank you, Vice Chair Norris. First on my list is Mark Jorgensen. All right.
Correct,
We
Madam
got that
Chair.
right. Welcome to the committee. Please just introduce yourself as you get
Thank you
started.
very much. My name is Mark Jorgensen. I'm a retired Foreign Service officer, and I will tell you that I do not have as much data today as the last occupant of this chair, so hopefully
we'll
that's
forgive
good,
you.
maybe not so good. I'm a Minnesota native. I was born and grew up in Marshall, Minnesota. I did my undergraduate work at Hamline University and my graduate work at the University of St. Thomas. I retired as a U.S. Foreign Service Officer, or FSO, in November of 2021 when I was unceremoniously kicked out of Belarus after the country decided to reduce U.S. staffing at the embassy to 6 people. I retired after 24 years of service with the U.S. government, 19 of those years serving at different U.S. embassies across the world. I served tours in Russia, Malaysia, South Korea, Uzbekistan, Senegal, Moldova, and Belarus, and also TDY assignments or temporary duty assignments at many countries across the world, ranging anywhere from a few days up to 54 weeks. Even as a member of the U.S. Foreign Service, my wife Susan and I retained our Minnesota residency. My wife, also a Minnesota native, and I decided to retire in Minnesota because it offers us the lifestyle that we want. And to be quite honest, actually 4 seasons, although that didn't work out quite so well this winter. Maybe that's not a bad thing. I'm here today to ask you to consider providing the same tax treatment, an income subtraction to the Foreign Service pension as you do to military pensions received by many Minnesota residents. I'm in no way saying or trying to say that serving in the Foreign Service is directly comparable to serving in the U.S. military. However, there are many similarities. Foreign Service officers, as Representative Norris mentioned, serve in both war zones and hotspots across the world, many times directly with their military counterparts. There are currently Foreign Service officers stationed in many war zones and hotspots, including Ukraine, Sudan, Ethiopia, Haiti, Myanmar, Azerbaijan, Niger, Mali, and Burkina Faso, just to name a few. In addition, FSOs routinely serve in other hostile, dangerous, and unhealthy countries in the world. I personally served in Russia, where not only me, but my wife were surveilled 24/7. Our apartment was routinely entered and bugged and videoed, and our car damaged on a regular basis, all by local government security services. In addition to continuing chronic medical issues within my family, picked up while serving outside the U.S., I have FSO friends that had very serious medical issues that were life-threatening and dangerous. One close friend needed to have his leg amputated because for several days he was unable to get a flight out of or a medevac flight into the country he was assigned to. Needless to say, the medical care there was not up to standard. I've had good friends who required disability retirements because they sustained physical injuries from IEDs and mortars while serving in war zones. Several Foreign Service posts around the world, in addition to issuing emergency radios upon arrival, also issue body armor and helmets. Since 1980 alone, more than 100 FSOs have been killed in the line of duty, including many in targeted bombings and shootings, as U.S. embassies have become targets for terrorists, drug lords, and anyone holding anti-American sentiments. As FSOs, we move routinely like members of the military, usually every 2 or 3 years, around the world to a new location, not just to another military base in the United States. As you can imagine, this puts significant stress and strain on our spouses and partners or other family members. Spouses or partners have a difficult time, at best, maintaining a career under these difficult conditions. If they are able to work, they are left either applying for extremely limited positions within the embassy of assignment, and rarely the same position from post to post, or trying to maintain business relationships from across the world. As an example, my wife followed me around the world, and as a result was only able to work intermittently, although not by choice. In the limited number of contract positions available at our embassies of assignment, she now relies on my Foreign Service pension because her Social Security earnings and resulting benefits were limited, as she was unable to pursue a career and accrue the financial benefits that go along with having a career. And like the military, the Foreign Service regularly assigns FSOs to many of the posts that are unaccompanied, splitting spouses or partners and family members who are not allowed to go to post while the FSO undertakes their tour of duty. These are just a few examples of the challenges FSOs face during their careers. So while I can't and won't directly equate the challenges of Foreign Service life with our esteemed colleagues in the military, you can see FSOs, their spouses or partners, and their family members face many of the same issues that military members face while we both serve our country. With that, thank you very much, and I will turn it over to my colleague, Mr. Olson.
Thank you very much for your testimony, Mr. Jorgensen, and thank you for your service. Mr. Olson, welcome to the committee. Please just identify yourself for the record as you get started with your testimony.
Okay. Madam Chair, thank you. My name is Carl Olson, and I am a resident of St. Louis Park since 2021. I am a second-generation Minnesotan. My father grew up in northwestern Wisconsin, and my mother grew up across from International Falls, and they both lived, worked, and studied in Minnesota in the 1950s. My mother was the county home agent in Thief River Falls in Pennington County. My father graduated from the University of Minnesota in 1962, and then they pursued opportunities. I grew up in Washington, D.C. area, and when I joined the Foreign Service in 1985, everybody assumed that I was from Minnesota. And I retired in 2016. My parents moved back in 2018, and in 2021, I finally made it official. And so I'm very happy to live here. In my Foreign Service career, I did visas and passports in Latin America, conventional arms control in Europe, and I worked a lot with the military. I was the first Foreign Service officer student at the U.S. Army Command and General Staff College in Fort Leavenworth, Kansas. And in my work with them, both domestically and overseas, I can see things that they don't, so I can add substantial value in helping America to succeed. I was at the military headquarters in Iraq, in Baghdad, and then in Afghanistan at the provincial level, and I was issued body armor and a helmet, and I tried to dig out the special blast-proof glasses that I still own. I speak Spanish and Portuguese, and I've also studied French and German, and I have used Spanish here in Minnesota as an election judge in Minneapolis. And many of us, learning a foreign language is a great thing because you can keep it. I'd like to add that the Foreign Service, like the military, is an up or out personnel system. You can't stay at the same level forever, and there is also a maximum time in service. So there is continuous turnover naturally. And then there's mandatory retirement at age 65, though most people reach their mandatory limits earlier. And then as a plug for recruitment, the maximum, unlike the military, the maximum age to enter the Foreign Service is 59. They want to get 2 years out of you. And it's a wonderful thing for people who are less encumbered to do. I mean, you learn a language, you live in a foreign country, and you represent America. Thank you.
Thank you very much, Mr. Olson, for your testimony and for your service to our country. We appreciate you being here. Is there any discussion on the bill? Representative Robbins.
Thank you, Madam Chair, and thank you, Representative Norris, for bringing this bill. Maybe this is more for Mr. Williams, but I'd just like to understand, how do we treat other pensions? I know that generally you guys already paid Social Security, so it's not considered the basic, right? So are there other pensions that paid Social Security that, besides military, we let do this? And then how do we treat other pension income? Thank you.
Mr. Williams.
Chair Gomez and Representative Robbins, I think you've got it pretty much correct. So last year we enacted that subtraction for basic pension income, is kind of, we call them colloquially in Minnesota. Those are uncoordinated pension plans that don't, they're pension plans where earning service for that pension doesn't earn service towards Social Security. And that's sort of an income tested, and it's limited to $25,000 for married couples filing joint returns. There's also in current law, as the testifiers mentioned, a subtraction for military service pensions, and that one is not income tested and not capped at a particular amount. So I think that it's accurate to describe this as sort of providing analogous treatment for these foreign service pensions as the military pensions would receive. It's more similar to that than how we've given other preferences in state law for sort of state pensions or other federal pensions that are coordinated with Social Security.
Representative Robbins?
Thank you. And one more question. Do you know how other states treat this? I haven't looked at it.
Mr. Williams.
Chair Gomez and Representative Robbins, I don't have that off the top of my head. I know that historically Minnesota has also provided, I guess I would describe it as a broader subtraction for all kinds of pension income, and that was something I think that was repealed in the 1980s as we sort of adopted some of the federal treatment for Social Security and other things. This is long before my time, but that's a long way of saying I can get back to you on that question.
All right, Representative Robbins, you good? If it looks like it. All right, Representative Davids.
Thank you, Madam Chair. This is kind of I call it a cleanup bill, because in 2017, I think I carried the bill for the military pensions that they would not be taxed if they had 20 years or more and honorably discharged, those types of things. The foreign service officers came in really late and said, hey, how about us? We want to be in this too. And so it didn't happen, so it kind of went away for a few years. Now it's back, and I think it's time I think this is a good bill, and we should do this.
Great. Thank you, Representative Davids. Representative Pinto.
Thank you, Madam Chair, and thanks, Representative Norris. I'm just trying to get my head a little bit around the policy, because we have a situation where, as I understand it, both military and foreign service or worker pensions are taxable at the federal level, and both, of course, are federal. These are folks serving our country, including all of us, but at the federal level. We made the choice several years ago to exempt the one group of folks serving our country in that way. And I should say I'm greatly admire the work of our foreign service workers. I mean, you all are going out all over the world representing our country. I'm just trying to sort of figure out if at some point there'll be a limiting principle, because, as we start thinking about folks serving, especially, again, this is a state benefit for people serving our country. The federal government hasn't chosen to provide a benefit to either kind of federal person, a military or foreign service worker. And I guess I could imagine we could start thinking, especially a state benefit going to people providing particular service to our state, and then suddenly it starts going out to a number of groups. I'm actually not going to say any things I'm thinking of, because, of course, that'll probably end up being ideas for bills. But just to say, I think we probably could brainstorm together folks that would seem extremely worthy, especially at the state level, for a state benefit. Because it's just interesting to me, the federal government has not chosen to provide this benefit for you who are serving our country. Maybe our federal representatives should be doing that. Federal government, of course, can deficit spend; the state cannot. So I think it's really good, and especially the folks serving our country in the military. It makes sense to me to provide something similar to folks in foreign service. As I say, it makes me a little uncomfortable. It's not like this is something that's been in place for years either. We did it in 2017 under divided government at the time. So I'm just kind of trying to get my head around it just a little bit, if the bill's author has thoughts at all. But thank you, Chair.
Thank you. Representative Norris.
Chair Gomez and Representative Pinto, I think it's a fair question to ask, and I think that's the role that the Taxes Committee plays in looking at the various proposals that come along and deciding, is this, analogous enough to existing things that we have in the tax code? Is this where we draw the line? I happen to think, given how similar a lot of the environments that our foreign service officers operate in, and some of the other analogous things to military service, I think there's a compelling case for treating these pensions similarly. But that's certainly a robust debate that the committee should rightfully have around this or any other similar proposal.
Great. All right, great. Thank you, Representative Norris. I'm not seeing any other questions from the committee, which is good because we have like 30 seconds left. Representative Norris, any final remarks about your bill?
Chair Gomez, I'll just thank again Mr. Jorgensen and Mr. Olson for their service and for joining us today. The revenue note on this is relatively small, but I think that's a small price to pay for us to extend and show our gratitude to these foreign service officers as a state for their service, not only to our state, but to our country.
Great. Thank you so much, Representative Norris, and thank you again to our testifiers for being here. With that, Representative Norris will renew his motion that House File 3367 as amended. 33327. Oh, I'm messing this up. All right. Luckily, somebody's paying attention. 3327 as amended be laid over for possible inclusion in the 2024 tax bill, and the bill is laid over. Thank you. We're not going to be meeting tomorrow. We'll meet on Thursday, and we'll hear a few bills. So we'll see you then. With that, we are adjourned.